So today I want to talk about the cyclically adjusted price to earnings ratio, or the CAPE ratio. Again, you can see previous discussions by following these links here. Of course, it's also called the Shiller CAPE ratio or the PE10 ratio. Now, today I want to talk about what we should expect given the fact that in the United States, the current CAPE ratio is around 33.5. So let's take a look at the CAPE ratio over time here in the US. We can see that it's only been higher during the internet bubble. We know how that ended. I've also drawn in here an average line, somewhere around 24, and some standard deviation lines. So we can see that right now, from a valuation perspective, the US is more than one standard deviation more expensive than average. I will remind you that I don't like PE ratios. They create distortions. They're not linear. They're not intuitive. You can see discussions about that if you follow these links here. But today we're just going to look at the CAPE ratio as opposed to the cyclically adjusted earnings ratio, just because it's going to be a little simpler given the data that we have. But my criticisms do not go away. Now, what I want to think about is, given a particular CAPE ratio, what might future returns look like? Here's a graph that gives us some sense of that. Now, it is a little bit time dependent. If you go from 1926 to 2011, the R squared is only 43%, but more recently from 1995 to 2020, it's been about 90% with a standard deviation of 1.37. So it's been pretty predictive. And the idea here is that if things are expensive or the CAPE ratio is very high, then future returns are very low. If the CAPE ratio is very low or things are cheap, future returns are very high. And we can see this is a pretty, it's a pretty causal relationship here. At least it appears to be. Now, we can also think about, well, given today, what might we expect? Things don't look that great. On average, if we go back to normal, we're only going to see, a very small return to the stock market. Even if we're pretty lucky, we're going to see something below average. Here's another way of looking at it. If we say, incorporating dividend yields in here, looking at a starting CAPE ratio of 30, it's really, again, 33. We can see again that we're going to have below average returns in most scenarios. That's not to say it's not possible for us to go to all-time highs in the CAPE ratio, but we should expect, given the nature and the level of the CAPE ratio here in the United States, that we are going to have below average returns over that 10 to 15 year time period. That's not to say that in there somewhere we won't have very good returns. Now, here's a great chart because we can look at it across the globe. So we look on the left-hand column here, we have a bunch of different countries, and on the top we have different CAPE ratios. We also have the averages by country. If you think back to my previous videos, you can see that, yes, again, we demonstrate here the United States is not special. It should not have or has not typically had an above average CAPE ratio, although right now today it has the highest CAPE ratio on the planet. And at the top you can see different CAPE ratios there. And we can see that, again, the lower the starting CAPE ratio, the better the subsequent returns, right? And if we go over here right now, we're going to off this chart. We're in the worst case scenario, the most expensive valuations in the United States. And we can see the returns get ugly in that column. We should expect very much below average returns over the next 15 years. So keep that in mind. Feel free to pause it, take a better look at this. Lots of good data here, but again, the message is pretty clear. So next time we're going to talk about, well, if the United States is the most expensive market on the planet, where are the bargains? Where should we be looking to find returns that will be above average? So we're looking for, low CAPE ratios, above average return, high CAPE ratios, United States, below average returns. And we'll talk about that next time. Thanks so much.